Introduction. What if I told you that your biggest trading losses had nothing to do with the market and everything to do with you? If you've ever stared at your screen thinking, "Why did I do that?" you're not alone. I've been trading for over 20 years. I've seen traders turn $500 into $5,000 and then back to $0 in a month. I've done it myself, not once, multiple times. And every single time, it came down to a mistake I didn't know I was making until it was too late. This book isn't just about technical analysis or market strategies. It's about the 100 painful, humbling, and eye-opening mistakes I made that nearly ended my trading career, but also helped me master it. These are the things I wish someone told me when I started. No fluff, no hype, just raw, honest lessons. If you're tired of blowing up accounts, doubting yourself, or feeling like you're always one step behind in the markets, this book is for you. Let's fix the mistakes, one chapter at a time.
Chapter 1. Chasing Quick Wins. When I first entered the world of trading, I didn't care about process, discipline, or consistency. I wanted to get rich, fast, like tomorrow. I thought trading was the ultimate shortcut to financial freedom. No boss, no schedule, just me and my screen, printing money while sipping coffee in sweatpants. Sounds perfect, right? That fantasy didn't just cost me money, it nearly destroyed my relationship with money itself. Let's be honest, if you're reading this, there's a good chance you've also been lured by the dream of making quick profits. Maybe you've watched someone on YouTube flip $1,000 into $10,000 in 2 weeks. Maybe you joined a Discord group where people post massive P&L screenshots daily. Maybe you thought, if they can do it, why not me? That's the trap, and chasing quick wins is how it starts. In the beginning, I believed every green day confirmed I was a genius. When I doubled my small account in 2 weeks, I felt like I had cracked the code. I ignored the fact that I was risking 50% of my capital on a single trade. I didn't care that I had no stop loss, no risk management, no plan. All I cared was the money. But trading doesn't work like that, not for long. See, the market has a cruel sense of humor. It rewards bad behavior just enough to keep you addicted. Your first big win feels like magic, but what you don't realize is that it's also teaching your brain that reckless equals reward. That's where the real damage begins, not in your account, but in your mindset. Quick wins create bad habits that are hard to break. They make you believe that trading is easy. They make you think you don't need to study, plan, or improve. You start skipping risk management. You start over-leveraging. You start trading every setup that looks like it might go. And when it doesn't, you double down to make it back. That's not trading. That's gambling with better graphics. What I learned the hard way is that sustainable profits never come from shortcuts. You don't master trading by hitting a lucky home run, you master it by consistently hitting singles, managing risk, and surviving long enough to let compounding do its work. The problem with chasing fast money is that it rewires your expectations. You start feeling like making 2% in a week isn't enough. You want 20%, then 50%. And that mindset pushes you into trades that don't fit your strategy, or worse, makes you abandon your strategy altogether. Here's a truth most new traders don't want to hear. The market doesn't care how badly you want to make money. It rewards discipline, patience, and process. It punishes neediness, greed, and desperation. And when you're chasing fast profits, you're operating from all three. I remember one week where I turned $5,000 into $8,200 using zero risk management and all emotion. The dopamine hit was insane. I felt unstoppable. The next week, I gave it all back, plus more. I ended that month with $2,900 in the account and a ton of emotional damage. And the worst part, I still felt like I had almost figured it out. That's how dangerous the quick wins mindset is. It gives you the illusion of progress while eroding your foundation underneath. Real trading success comes from building good habits that feel boring in the short term but powerful in the long run. waiting for your setup, taking only high-probability trades, accepting small losses, following your rules like a robot. That's what makes the difference between gamblers and professionals. One of my mentors once told me, if your goal is to make a lot of money fast, you'll end up broke slowly. That hit hard, because it was true. Every time I focused on speed, I traded worse. But when I focused on process, the money came, slowly, steadily, and with far less stress. Let's talk about the psychological damage that chasing quick wins can do, because it's deeper than most people think. When you start expecting fast results, you build unrealistic timelines in your head. You believe success is supposed to be immediate, and when it isn't, you feel like a failure. That leads to anxiety, frustration, and often quitting too soon. I've watched brilliant traders walk away from the game simply because they didn't hit their 5K per month goal in their first 90 days. Trading is a skill, not a lottery ticket. Think about it. Would you expect to become a pro athlete in 3 months? A brain surgeon in 6? Of course not. But somehow we expect to master the markets in weeks just because someone on Instagram made it look easy. Here's the truth. The most consistent traders I know took years to build their edge, and they all have one thing in common. They stopped chasing fast money and started chasing good decisions. Let me break down what I wish I had done earlier. I wish I had focused on learning risk management before anything else. I wish I had journaled every trade and reviewed it weekly. I wish I had aimed for consistency, not fireworks. I wish I had stopped comparing my progress to someone else's highlight reel. And most of all, I wish I understood that chasing quick wins was actually a form of insecurity. It wasn't about making money, it was about proving something. To myself, to others, to the world. Once I let go of that need for speed, everything changed. I started trusting my process. I started caring more about following my rules than about how much I made today. I celebrated small green days like I used to celebrate big ones. And over time, the results became shockingly stable. Here's the irony. The fastest way to grow your account is to stop trying to grow it fast. Because when you're not rushing, you make better decisions. And when you make better decisions, your equity curve stops looking like a roller coaster and starts looking like a staircase. So if you're currently chasing quick wins, here's what I want you to do. Pause. Step back. Ask yourself, what's the rush? Are you trying to pay off debt? Prove someone wrong? Escape your 9-to-5? Impress people online? Whatever the reason, acknowledge it. Understand it, but don't let it drive your trading decisions. Instead, make this your new goal. Become a trader who survives, who manages risk, who thinks long-term, who treats the game with respect. Because the truth is, you can either chase fast money and lose it all, or you can trade smart and let time compound your edge. The market isn't a sprint. It's a marathon with no finish line. And the traders who last, they're the ones who stopped chasing and started building.
Chapter 2. No Plan, No Profit. It's hard to admit this, but for the first few years of my trading journey, I had absolutely no real plan. I thought I did, but what I had was a collection of random strategies I picked up from forums, YouTube videos, and Twitter threads. One day, I'd scalp small-cap stocks. The next, I'd swing trade SPY options. Sometimes I'd go long, sometimes I'd short. It all depended on how I felt that day. I was reacting to the market, not preparing for it. And guess what? My results were just as random as my approach. It wasn't until I got tired of losing money, burning out emotionally, and second-guessing every decision that I realized what was missing: a real, structured trading plan. Let me say this clearly. If you don't have a plan, you don't have a business. And yes, trading is a business. Most people treat it like a hobby. They log into their broker account, look at a chart, and jump into trades with no rules, no consistency, and no understanding of what they're trying to do. That's not trading. That's flipping a coin and hoping for the best. Imagine a pilot flying a plane with no flight plan. or a surgeon operating without a medical chart, or a construction crew starting to build a skyscraper without a blueprint. It would be insane. But that's exactly what most new traders do every single day. No pre-market prep, no risk parameters, no entry criteria, just vibes. I used to think planning was for weak traders, that real pros read the market in the moment and adjusted on the fly. But what I didn't realize was that all the experienced traders I looked up to did have a plan. They were just so comfortable with it that it looked effortless. They weren't guessing, they were executing. And that's the difference between consistent winners and everyone else. See, a trading plan isn't just a list of rules, it's your framework for survival. It protects you from impulsive decisions. It keeps you grounded when your emotions are flying. It gives you a system to evaluate your trades and improve over time. Without it, you're just reacting to chaos with more chaos. When I finally sat down and wrote out a detailed trading plan, it was honestly uncomfortable. I had to admit how sloppy I'd been. I had to define things I'd been avoiding, like my max daily loss, my setup criteria, and my risk per trade. I had to accept that some trades I wanted to take didn't actually fit my plan. And that hurt my ego. But here's what happened next. My performance instantly improved. Not because I became a better trader overnight, but because I stopped making stupid mistakes. I stopped entering random trades just because something looked good. I stopped chasing losses. I stopped holding losers out of hope. My plan became my anchor. Let's break this down a bit more, because most people misunderstand what a plan actually includes. It's not just, I'll buy if the price breaks out, or I'll trade when I feel good. A real plan defines everything. Your trading hours, your setups, your risk management rules, your position sizing, your exit strategy, your journaling process, and even your emotional triggers. It's a roadmap. Without it, you're just wandering. One of the most dangerous things about trading without a plan is that you can't measure or repeat anything. If you make a winning trade, you don't know why it worked. If you lose, you can't tell whether it was a bad decision or just normal variance. And that lack of clarity creates self-doubt, overthinking, and eventually, burnout. I know traders who had potential, who were smart and driven, but they never created a plan, and they all burned out. One guy I mentored was insanely talented at reading price action, but every trade he took was based on his gut. Some days he'd make thousands, other days he'd lose it all. After 6 months, he quit. He couldn't handle the emotional roller coaster. But the problem wasn't his ability, it was his lack of structure. That's the thing, trading is a game of probabilities. Your edge only plays out over time if you follow it consistently. And consistency is impossible without a plan. Let me give you a personal example. I used to trade breakouts with no real criteria. If a stock started spiking, I'd jump in. Sometimes it worked, sometimes it didn't. But when I sat down and created a detailed plan around that strategy, I got specific. I only took breakouts on stocks with above-average volume, strong daily chart structure, and a clean catalyst. I defined my entry point, stop loss, and profit target before I entered the trade. And, most importantly, I tracked every trade and reviewed it weekly. What changed? Everything. My win rate improved, my risk-to-reward ratio tightened, I started cutting losses quickly and letting winners run, I stopped overtrading, I stopped revenge trading, I finally felt like a professional, not a gambler. Now, here's a truth that might sting. Most people avoid making a plan because it forces them to take responsibility. When you have no plan, every bad trade can be blamed on bad luck or the market was crazy. But when you have a plan, your results are a direct reflection of your decisions. That's scary, but it's also empowering. Because once you own your decisions, you can start to improve them. One of the biggest lies in trading is that you need to constantly change strategies. What you really need is to stick to one plan long enough to see if it works. Most traders jump from one strategy to another after a few losses. They say this doesn't work and move on, without ever truly executing the plan properly. It's like planting seeds and digging them up every day to see if they've grown. You don't need a perfect plan. You need a repeatable plan. And here's another surprising benefit of having a plan. It reduces stress. When you know what you're looking for, what you'll do in every situation, and how much you're risking, the emotional weight of trading disappears. You're not constantly second-guessing. You're not glued to your screen for 8 hours straight. You become efficient, confident, and focused. I used to spend all day watching the market. After I built my plan, I only needed 60 to 90 minutes to execute. I knew exactly when to enter, when to exit, and when to walk away. Trading stopped controlling my life. I took back my time, my peace of mind, and eventually, my profits. One thing I encourage every trader to do is build a simple checklist based on their plan. Before every trade, ask yourself, does this trade match my setup criteria? Is the risk-reward at least 2 to 1? Am I within my daily risk limit? Do I have a defined exit plan? Am I trading emotionally or logically? If the answer isn't a clear yes to all, don't take the trade. It's that simple. Some people resist this level of discipline because it feels restrictive. But the truth is, structure creates freedom. When you have clear rules, you don't waste energy debating every decision. You can trust the process, and that trust leads to confidence, and confidence leads to better performance. Let me leave you with this. The market is a complex, ever-changing beast. You will never be able to control it, but you can control yourself. And the way you do that is by having a plan that you trust, a plan that you follow, a plan that evolves with you as you grow. Every successful trader I know, every single one, has a plan they live and die by. It's not optional. It's the foundation of their success. So, if you're still trading without one, let today be the day you stop. Because without a plan, you're not a trader. You're just gambling with a high-speed internet connection. And in the long run, the house always wins. But with a plan, you give yourself a fighting chance, not just to survive, but to thrive.
Chapter 3. Overtrading is self-sabotage. There's a silent killer in the trading world. It's not bad strategy. It's not poor technical analysis. It's not even losing trades. It's something more subtle, more psychological. It's overtrading. And I can tell you from experience, it's one of the most destructive habits a trader can fall into. It ruins accounts. It wrecks confidence. It drains emotional capital. And worst of all, it convinces you that you're being productive, when in reality, you're just spinning your wheels. Overtrading is what happens when you feel the need to trade, even when there's no setup. It's the compulsion to do something because the market is open. It's logging into your broker, seeing a green or red candlestick, and clicking the buy or sell button without truly thinking through the trade. It feels like action. It feels like hustle, but it's self-sabotage disguised as effort. When I first started trading, I believed that more trades meant more opportunities to make money. If I wasn't trading, I felt lazy, unproductive, like I was falling behind. So I traded everything I could find. If a stock moved even slightly, I was in. I didn't care if it fit my setup. I didn't care about context. I just wanted to be in the game. And sure, I had a few good days, but most days ended in regret, frustration, and self-blame. I didn't realize it then, but I was addicted, not to trading, but to the illusion of progress. Overtrading gave me a false sense of control. It made me feel like I was working hard, but in reality, I was just burning money and emotional energy. Here's what most people don't understand. Trading is 90% waiting. Waiting for your setup, waiting for your entry, waiting for confirmation, waiting for the right environment. But for many traders, that waiting is unbearable. They get bored. They get antsy. They convince themselves that a decent setup is good enough. And that's when the damage starts. The truth is, overtrading stems from impatience and insecurity. When you don't fully trust your edge, or when you haven't built one, you try to force the market to give you what you want. You believe that the next trade might be the one. So you keep clicking, hoping that action will lead to profit. But hope isn't a strategy. And over time, overtrading leads to overexposure, poor risk management, and emotional exhaustion. Let me walk you through a day I'll never forget. It was a Tuesday morning. The market had just opened. I didn't see anything special, but I felt like I had to trade. I took a scalp on a mid-cap stock that was consolidating. No real breakout, no catalyst. I just didn't want to miss out. It went against me. I added more. It dropped further. I cut it. Then I jumped into another random trade 5 minutes later to make it back. And another. By the end of the day, I had made 17 trades and lost $3,800. Not because I lacked skill. Not because the market was irrational. Because I couldn't sit still. That's the cost of overtrading. Not just financial, but psychological. You start questioning your process. You feel mentally fried. You doubt your system. You blame the market. And worst of all, you stop trusting yourself. One of the most dangerous things about overtrading is that it's often rewarded just enough to keep you hooked. Every now and then, you'll have a big green day from taking lots of trades. That hit of dopamine tells your brain, this works. But what you don't see is the damage it's doing long term. It's teaching you that more equals better, and that's rarely true in trading. Some of the most successful traders I know take one trade a day, sometimes less. They sit, they wait, they stalk the market like a sniper, and when the perfect setup comes, they strike. That's it. That's their edge. It's not about quantity, it's about quality. I want you to ask yourself a hard question. Why do you trade so much? Is it boredom? Fear of missing out? A need to prove something? Are you chasing a high? Are you using trading to escape other parts of your life? Because until you understand why you overtrade, you won't be able to stop. I had to dig deep to realize that I was using trading as a way to feel in control. In a life full of uncertainty, the markets gave me a sense of power. Every click of the mouse was like saying, I'm doing something. But that illusion of control was costing me dearly. I wasn't building wealth. I was feeding a habit. One of the most powerful changes I made was setting daily trade limits. At first, it felt restrictive, but soon it became liberating. I'd limit myself to 2 to 3 trades per day, win or lose. If I hit that limit, I walked away. No exceptions. It forced me to be more selective, more disciplined, more intentional. My win rate improved, my account stabilized, and most importantly, my mental health recovered. Another shift was redefining what productivity meant. In trading, sitting on your hands is a skill. Watching the market without taking a trade is a sign of strength, not weakness. True pros don't measure success by how many trades they take, but by how well they follow their plan. Let me tell you what overtrading really steals from you. It steals your edge. Every trader has a certain amount of mental capital each day. It's not unlimited. The more decisions you make, the more fatigued your brain becomes. By your 10th trade of the day, you're no longer operating with clarity. You're reacting. You're emotional. You're chasing. That's when mistakes happen. And mistakes cost more than just money. They cost confidence. When you overtrade, your losing days get bigger. Your winning days get smaller. Your emotions start to control your decisions. You hesitate when you should act. You jump in when you should wait. You become inconsistent, and inconsistency is the enemy of compounding. I remember reading an interview with a veteran trader who said, I make 90% of my yearly income from 10 trades. That hit me hard, because it forced me to ask, why am I taking 500 plus trades a year when I only need 10 good ones to hit my goals? It's not about doing more. It's about doing less, but doing it better. You have to develop what I call selective aggression. You're not passive, you're patient. You don't trade less because you're scared. You trade less because you're strategic. Overtrading is emotional. Discipline is strategic. So what does it take to stop overtrading? It takes brutal self-honesty. It takes rules. It takes walking away from the screen when nothing's happening. It takes redefining success, not as profit,
but his process. When I finally started seeing consistent gains, it wasn't because I found a magic indicator. It was because I learned to sit still, how to wait, how to trust my process enough to not trade when the setup wasn't perfect. Here's something else most traders won't admit. Sometimes the best trade is no trade. Let me say that again. The best decision you can make on a given day might be to stay out, and that's not a failure. That's discipline in action. Let's say you overtrade today and lose $800 chasing setups. Tomorrow, you trade perfectly and make $300. What's the real story here? You were never lacking skill. You were lacking restraint. I'd rather take 3 A-plus trades a week than 30 mediocre ones, because those A-plus trades are where your edge lives. Everything else, noise, temptation, distraction. One thing that helped me tremendously was journaling every single trade, especially the ones I shouldn't have taken. When you see in black and white how many of your losing trades were impulsive, it's sobering. Over time, your journal becomes a mirror. It doesn't lie. It shows you patterns, good and bad. And most importantly, it gives you the data you need to change. Another trick? Walk away after a winning trade. Seriously. One of the most common overtrading traps is the "I'm hot today" mindset. You catch a nice win and suddenly you think you can't miss, so you keep trading. And then you give it all back, and more. When I stopped trading after my first solid win of the day, my weekly profits tripled. Not because I was smarter, but because I was done chasing. I want you to understand something powerful. The market will always be there tomorrow. Always. If you miss a setup today, there will be another one. If you don't trade today, you haven't missed out. You've preserved your capital and your confidence. That's a win. The traders that last in this game are the ones who learn to master themselves. Not the ones who can call every top or bottom, not the ones who trade 12 hours a day, the ones who know when to attack and when to wait. Overtrading isn't a problem with the market, it's a problem with you. But that also means you have the power to fix it. So next time you feel that itch to take just one more trade, ask yourself, am I following my plan or feeding my impulse? Is this trade backed by logic or driven by emotion? Is this part of my strategy or am I just bored? And if the answer isn't crystal clear, step away. You'll thank yourself later, because in trading, doing less is often the smartest move you can make.
Chapter 4. Revenge Trading is a Trap. It starts with a single loss. A trade you were confident about goes the other way, fast. Maybe you ignored your stop loss. Maybe you thought it would bounce. Maybe you were right for a few minutes and then the market flipped against you. Either way, you're now down, not just financially, but emotionally. That's when the dangerous thought creeps in, I need to make it back. That one sentence is the start of a spiral. It's not a strategy, it's not logic, it's emotion. And when emotion takes over, the trader disappears and the gambler steps in. Revenge trading is one of the most toxic habits in this entire game. I've fallen into it more times than I'd like to admit. It doesn't matter how experienced you are, if you're not careful, the market will poke your ego, slap your confidence, and invite you to fight back. And that's the trap. At its core, revenge trading is about emotional justice. You feel wronged. You feel disrespected by the market. You believe that the money you just lost wasn't supposed to be lost. So you chase trades, you size up, and you throw discipline out the window, all in the name of getting even. But here's the brutal truth. The market doesn't care. It doesn't care about your feelings, your goals, your rent, your dreams, or your past trades. It doesn't owe you anything. And the moment you try to get back at it, you're already losing. I remember one morning when I lost $1,200 on a single trade because I ignored my stop. I was mad, furious really. I felt like the setup was perfect and the market tricked me. So I immediately jumped into another trade, hoping to recover fast. That one lost $600. I doubled down, lost again.
By noon, I was down over $4,000. Not because the market was unfair, but because I let my ego take the wheel. That day taught me a painful lesson. Trading isn't about being right, it's about being rational. And revenge trading is the most irrational behavior a trader can engage in. The worst part is that it often feels justified. You tell yourself, I've studied, I know this setup works, I just got unlucky. Let me go again and fix it. But what you're really doing is trying to erase emotional discomfort. You're not trading to follow a process, you're trading to feel better. And that's where the danger lies. Because when you trade emotionally, your rules vanish, your risk management goes out the window, your judgment gets cloudy. You take trades that don't match your setup, you size up to get it back faster, you stay in losing positions longer than you should, hoping they'll reverse, and you ignore every piece of logic you spent months or years building. I used to think I was immune to this. I thought revenge trading was something only rookies did. But I've seen it hit traders with 10, even 15 years of experience. Why? Because revenge trading isn't about skill, it's about emotional regulation. And emotions don't care how long you've been in the game. What I eventually realized is that revenge trading is rooted in identity. When you take a big loss, it doesn't just hurt your account, it threatens how you see yourself. You don't want to be a losing trader. You want to prove to yourself and maybe to others that you can win. So you fight back. You try to rewrite the narrative. You try to restore your identity. But in doing so, you dig a deeper hole. One of the worst days in my trading career came after a small red day. I was down $600. Not a big deal. But it felt like a failure because I had been green for 8 straight days. My ego didn't want the streak to end, so I took one more trade, then another. And by the end of the day, I was down $3,200, all because I couldn't accept being red. That's the thing about revenge trading. It rarely starts with a huge loss. It starts with your inability to accept a small one. I had to learn how to separate my identity from my results. A red day doesn't mean I'm a bad trader. A loss doesn't mean I've failed. But when you don't believe that, you feel compelled to fix your results as fast as possible. And that urgency is a poison. It took me years to understand that trading is about playing the long game. Every trader has losing days. Every strategy has drawdowns. Every system has bad weeks. But revenge trading turns a manageable setback into a catastrophe. So, how do you stop it? The first step is awareness. You need to recognize when your emotions are taking over. That voice in your head saying, just one more trade, that's not your strategy speaking. That's your ego begging for relief. When you hear it, pause. Step away from your desk. Get some fresh air. Because once your emotions spike, your decision-making declines. The second step is building hard rules. One of the best things I ever did was implement a 3-strike rule. If I take 3 trades and all 3 are red, I'm done for the day. No exceptions. Even if the market suddenly explodes with opportunity. Why? Because I know my emotional state is compromised after 3 losses. My edge is gone. Discipline is low, and the risk of revenge trading is high. Another rule I created was setting a daily loss limit. If I'm down more than a certain dollar amount, let's say $1,000, I shut it down. I don't try to make it back. I don't try to find the next home run. I walk away. Because if I let that red day spiral, it won't just hurt my account. It'll carry over into tomorrow. And that's when traders start compounding mistakes across multiple days, which leads to serious long-term damage. But rules alone aren't enough. You need to understand why you feel the urge to take revenge. For many traders, it's about control. The market feels like it just took something from you, and you want to take it back. You want to restore the balance. You want to feel in charge again. But trading isn't about control. It's about acceptance. You need to accept that losses are part of the game, that even your best setups will fail, that no matter how hard you work, some days you will lose money. And that's okay. One exercise that helped me was reframing how I view red days. Instead of seeing them as failures, I began seeing them as tuition, the cost of doing business, the price I pay to stay in the game long enough to let my edge play out. When I stopped fearing losses, I stopped feeling the need to get revenge on them. I also started journaling my emotions, not just my trades. After every loss, I'd write down how I felt, what thoughts were running through my mind, and what actions I wanted to take. This helped me build emotional awareness. Over time, I could spot patterns. I'd see the same emotional triggers show up again and again, and I learned how to manage them instead of being controlled by them. Here's something important. Revenge trading doesn't just hurt your account. It damages your mindset. It chips away at your discipline. It creates shame, and it makes you lose trust in yourself. Once you break your rules to chase losses, it becomes easier to do it again and again. And before you know it, your system is gone, and you're trading on emotion alone. To rebuild that trust, I had to go back to basics. I created a simple checklist. I stopped sizing up. I focused on executing just one good trade per day, and I celebrated process over profit. Slowly, my confidence returned because I wasn't trying to win. I was trying to be consistent. And consistency beats revenge every time. I also leaned on accountability. I had a trading partner I'd text every day. If I took a loss, I'd message him immediately. Just that small act of sharing helped break the emotional loop. It reminded me, I'm not alone. Every trader faces this, and the ones who succeed are the ones who manage their emotions, not erase them. There's one more thing I want to share with you, and it might be the most important. The market is not your enemy. It's not out to get you. It's not punishing you. It's just doing what it does. When you treat it like an opponent, you create unnecessary tension. You make it personal. And trading should never be personal. It's just a game of probabilities. Some days you win, some days you don't. But none of it defines you, unless you let it. Once I stopped seeing the market as a battlefield, I became more peaceful, more patient, more disciplined, and yes, more profitable. So if you're stuck in the revenge cycle, I want you to take a deep breath, forgive yourself, walk away for the day, and come back tomorrow with a clear head and a plan. You don't need to make it all back today. You just need to trade well, over and over, until the process takes care of the results. Because the moment you stop fighting the market and start flowing with it, is the moment everything changes.
Chapter 5. Ignoring risk equals blowing up. You can have the best setup. You can time the market with sniper precision. You can read price action like a seasoned pro. But if you don't manage risk, none of it matters. Because eventually, maybe not today, maybe not tomorrow, but eventually you will blow up. Risk is not the exciting part of trading. It's not flashy. It doesn't sell courses. Nobody on social media posts screenshots of the trades they didn't take or the money they saved by cutting a loss early. But that's where the real edge is built. That's where long-term traders separate themselves from the emotional crowd. Risk management is the backbone of trading. Early in my career, I didn't get this. I thought risk management was for scared traders. I thought sizing down meant weakness. I was focused on winning, big. I wanted 10x trades, massive breakouts, 5-figure days. And when those didn't come, I kept increasing size, hoping the next trade would make up for it all. You can guess how that ended. Over and over, I'd grow my account, then give it all back in 1 or 2 undisciplined trades. Every time I lost big, I'd tell myself it was a fluke. I'd say, I just need to fix my entries, or the setup betrayed me. But the problem wasn't the setup. The problem was that I never had a risk management strategy. I didn't have a system to protect myself from myself. Here's the cold truth. The best traders are not the ones who make the most money when they're right. They're the ones who lose the least when they're wrong. Risk is baked into trading. It's not optional. Every trade you take is a probability game. You might have an edge. You might have backtested a setup with a 70% win rate. But that still means 3 out of 10 trades will lose. If you don't control the size of those losses, the wins don't matter. A single oversized loss can erase weeks or months of progress. And yet most new traders ignore this. They focus on strategy, on indicators, on getting better at entries. And yes, those are important. But without risk control, you're building a mansion on quicksand. Let me give you an example. I once had a setup that worked 8 times in a row. Clean breakout, volume confirmation, news catalyst. It had everything. I got used to it working. So one day, I sized up. Big. Way beyond my normal risk. I figured I had earned the right to go big. But this time, the stock failed. Hard. No bounce, no pullback, just straight down. Because I had sized up without a plan, I froze. I didn't want to take the loss. I hoped it would bounce back. It didn't. I watched as my biggest winner of the month became my biggest loss of the year. And all because I ignored risk. That was the day I learned that hope has no place in trading. Risk management isn't about being conservative. It's about being a professional. Imagine running a restaurant. You know not every ingredient will sell. You know some dishes will flop. So you don't spend your entire budget on one meal. You manage the kitchen. You plan for losses. That's how you stay in business. Trading is no different. The market will test your discipline. It will throw random days at you. News events, gaps, flash crashes, fat finger mistakes. If your entire account is exposed at once, one bad moment is all it takes to destroy years of effort. Let's get practical for a second. Most traders lose because they don't define risk before the trade. They enter hoping it works. If it goes against them, they adjust the stop loss mentally. Let's give it some room. That's not risk management. That's emotional coping. That's how small losses become massive ones. And that's how traders blow up. Real risk management means you know exactly how much you're willing to lose on every trade before you click buy. It means having a max daily loss, a weekly circuit breaker. It means understanding position sizing based on risk, not based on greed. For example, if you have a $10,000 account and you're risking 1% per trade, that's $100. That $100 is your line. You build your position size based on how far your stop is. If the stop is 50 cents away, you can buy 200 shares. That's it. If the stop is $1 away, you buy 100 shares. You don't trade more just because you feel good about this setup. The goal is not to avoid losses. The goal is to make sure no single loss hurts you. This simple principle changed my entire trading career. Once I respected the 1% rule, I stopped having catastrophic days. I still had losing trades, sure, but they were manageable. They didn't spiral into panic. I could analyze them, learn from them, and move on. And over time, something magical happened. Consistency. When you control your downside, your upside becomes smoother. Your equity curve starts to grow, slowly but steadily. You stop thinking about making it back. You stop waking up in anxiety because of some oversized overnight position. You stop reacting and start executing. There's something incredibly powerful about knowing, even if this trade fails, I'll be fine. That confidence doesn't come from being right. It comes from knowing your risk is in check. It lets you sleep at night. It lets you trade without fear. It gives you the clarity to wait for better setups because you're no longer chasing your losses. Let me talk about emotional risk too, because this is just as important as financial risk. Every trader has a threshold, not just in money, but in mental energy. If you're risking too much per trade, you start to feel the pressure. You become tense. You watch the chart tick by tick. You second-guess everything. You hesitate, or worse, you panic. I've seen traders completely abandon their system just because they were in too deep emotionally. Even if they knew the setup was good, they couldn't follow through. Why? Because they had too much on the line. Their rent, their ego, their reputation. So they made emotional decisions instead of strategic ones. That's why trading small, even when you know what you're doing, is not weakness, it's wisdom. If your current size is causing stress, reduce it. Trade 1/10 of what you're used to. Build confidence, build discipline. When your decisions are clean, the size will follow. Here's another overlooked part of risk: market conditions. Your risk should not be fixed like concrete. If volatility is high, if news is shaking up the market, if volume is dry, adjust. Sometimes the best risk management decision is not trading at all. Traders get into trouble when they treat every day the same. They wake up, they force a trade, and they ignore the context. Risk management isn't static, it's dynamic. It evolves with the environment. Some days your edge is strong. Some days the market is choppy and the risk is too high. You have to adapt. You have to know when to press and when to protect. One of the hardest pills to swallow is this: you can do everything right and still lose money. But if you have strong risk management, those losses are just part of the game. You take the hit, you regroup, and you live to trade another day. That's what professionals do. Amateurs try to win every time. Pros try to survive long enough to let the math work out. I want to say this again because it matters. Your number one job as a trader is not to make money, it's to protect capital. Money will come, setups will come, big trades will come, but capital? Once you lose it, you lose time. And time is your most valuable resource in trading. If you lose half your account in one bad trade, you now need a 100% return just to get back to even. That's a steep hill, and most traders never climb out of it. So stop thinking about how much you can make on a trade. Start thinking about how much you're willing to lose. If the answer is, "I don't know," or "I'll just cut it if it looks bad," you're not managing risk, you're gambling. Risk management is not just a technical skill, it's a mental commitment to discipline. It's the promise you make to yourself that you will never let one trade define your week, or your month, or your career. You can be wrong 40% of the time and still make a living, if you manage risk. You can have a system that only wins 3 out of 10 trades and still be profitable if your winners are bigger than your losers and your losses are contained. That's the game. That's the edge. No risk management equals no edge. No risk management equals no career. No risk management equals blowing up. If you've read this far, I want you to stop for a second and ask yourself, how much do I risk per trade? Do I have a max daily loss? Do I know how much I'm willing to lose this week? Am I trading with money I can afford to lose, or am I playing with fear? Your answers to those questions will determine how far you go in this game. It took me too long to learn this. I blew up accounts. I melted down emotionally. I quit trading twice. But every time I came back smarter, tougher, more disciplined, because I knew that without a risk plan, I was just another statistic. So now, every trade I take is built on one foundation. How much am I willing to lose? If I can answer that clearly and comfortably, I take the trade. If not, I don't. Simple. That mindset changed everything.
Chapter 6. Overleveraged, Overconfident. There's a dangerous dance that many traders fall into, especially early in their careers, and even some seasoned pros aren't immune. It's a toxic mix of overconfidence fueled by a string of wins, combined with the temptation of leverage, which lets you play bigger than you should. When these two collide, the result is almost always disaster. This chapter is about that trap, being overleveraged and overconfident. When you first start trading, it's normal to feel excitement. You learn a strategy, you test it on paper, then you take some real money and, boom, you hit a few winning trades in a row. Suddenly, the market feels like it's on your side. You start to believe you've unlocked a secret. You feel unstoppable. You think, "I'm a natural." And this is the exact moment where your ego whispers the most dangerous lies. Leverage is the financial equivalent of a double-edged sword. It can amplify your gains, but it amplifies your losses just as much, sometimes even more. For traders who don't fully understand this, leverage becomes a siren's call.
Trade bigger, trade faster, trade everything you have. Because with leverage, the thrill of bigger profits is intoxicating. You don't have to wait months to grow your account. You can do it overnight. But with that same power comes risk. And if you're not careful, you can wipe out your account just as fast. Let me tell you about my first experience with leverage and overconfidence. I had a small account, just a few $1,000s. After a few wins, I felt like the king of the world. I thought if I just increase my position size, I'll double my money in weeks. So I took on more leverage than I should have. I was trading big positions relative to my account size. It felt good at first. I saw my profits climb, but I was blind to the risks. Then came the market pullback. One bad trade wiped out 40% of my account in minutes. I was devastated. I couldn't believe it. I thought my strategy was bulletproof. I thought I was invincible. But the truth was clear. I had overleveraged, and my confidence blinded me to the dangers. Overconfidence is often described as a cognitive bias, a psychological trap where you overestimate your ability to predict or control outcomes. In trading, this bias is deadly. It makes you take bigger risks than you should, ignore warning signs, and underestimate the market's randomness. The market doesn't care about your past success or your ego. It will humble you in ways you never expect. The problem with overconfidence is that it's sneaky. It often grows quietly. After a series of wins, you feel great. You think, I'm getting better. But what's really happening is your brain is rewarding itself for being right. Dopamine floods in. You feel powerful. You start chasing bigger returns. You forget your rules. You push your leverage to the max. Leverage itself is a tool, not a strategy. It's like a chainsaw. In the right hands, it's powerful and effective. In the wrong hands, it's destructive. When traders use leverage without a clear understanding of risk, they set themselves up for ruin. One of the key mistakes I see is traders using maximum leverage offered by their brokers without calculating how much risk they are truly taking. Brokers often advertise high leverage ratios, 50x, 100x, even more, because it attracts customers. But that doesn't mean you have to use it. Just because you can risk $10,000 on a $1,000 account doesn't mean you should. Over-leveraging magnifies every mistake. A small misjudgment in your entry or exit turns into a catastrophic loss. You go from making a small error to blowing your account. And that's why many traders lose their entire accounts within months, even days, of starting. Another danger of overconfidence and leverage is revenge trading with bigger size. After a loss, some traders double down to get it back. This is emotional risk-taking, and when combined with high leverage, it's a recipe for disaster. Instead of cutting losses and moving on, they throw more money into the fire. It's the gambler's fallacy, believing the market owes you a win after a loss. Overconfidence also leads to ignoring your own rules. Maybe you have a risk limit of 2% per trade, but after a winning streak, you decide to push it to 5% or 10%. You skip setting stop losses. You chase the market. You deviate from your plan because you feel invincible. But trading is not about feelings. It's about discipline. What's worse, overconfidence can affect position sizing in subtle ways. You might think you're being careful, but because you're feeling hot, you increase your size just a little. It's a slippery slope. Each incremental increase seems harmless, but combined, they can put your account at serious risk. Another psychological effect is the illusion of control. When you're overconfident, you believe you can predict every move, outsmart every swing. You convince yourself that losses are because of bad luck or external factors. But the market is not a game you can control. It's a game you can learn to play probabilistically. If you try to control it, you will fail. The antidote to this is humility and respect for the market. Accept that no matter how many trades you win, you will lose sometimes. You will be wrong. You will face uncertainty. Embrace that reality. It's the only way to survive long-term. Let me share some practical ways to avoid the over-leverage, overconfidence trap. First, Always calculate your risk per trade before you enter. Know exactly how much you're risking, not just in dollars, but as a percentage of your total account. The 1% rule is a great starting point. This means you should never risk more than 1% of your account on a single trade. Yes, even if you feel confident. Second, use stop losses religiously. No exceptions. A stop loss is your safety net. It limits your downside. Overconfidence tempts you to remove stops or move them further away, but this is playing with fire. A stop loss ensures that one bad trade can't take you out. Third, be cautious about leverage itself. Just because your broker offers 50x leverage doesn't mean you need to use it. Use the minimum leverage you can to achieve your trade size. Sometimes, less is more. Fourth, track your emotions and ego. After a win, pause and reflect. Are you feeling more confident? Are you tempted to increase your size? If yes, slow down. Take a break. Review your plan. Make decisions from logic, not feelings. Fifth, develop a trading plan that includes clear maximum position sizes and risk limits. Stick to it no matter what. Your plan should protect you from yourself. Another important point is that overconfidence in leverage problems often worsen when you're trading with borrowed money or margin. If you're trading funds you can't afford to lose, the pressure and temptation increase. This often leads to emotional decision-making and reckless behavior. If you're serious about trading, treat your trading account like a business. Don't gamble. Manage your capital with care. Use leverage as a tool, not a shortcut. Overconfidence also shows up in overtrading, which we discussed earlier. After a few wins, some traders want to keep the momentum going. They take more trades, bigger trades, and higher leverage. This behavior is a sign of inflated ego. Remember, the market is indifferent to your success or failure. You must respect it every day. The reality is that successful trading is a marathon, not a sprint. You don't need to win big on every trade. You need to protect your capital so you can stay in the game long enough to win consistently. One way I measure my trading maturity is how comfortable I am being boring. Boring means consistent sizing. Boring means modest leverage. Boring means following rules even when you feel like you could push harder. The irony is that being boring is actually a superpower in trading. In contrast, chasing big wins with overconfidence and leverage is the sign of immaturity. It's chasing adrenaline, not profits, and that's where most traders fail. You should also understand that no strategy works all the time. If you think your strategy is perfect because you had a string of wins, you're setting yourself up for a rude awakening. The market changes, trends reverse, volatility shifts. If you're overconfident, you won't adapt. You'll keep using the same size and leverage even when conditions worsen. This is a fast track to blowing up. Another powerful habit is to review your trades regularly. Analyze your losses. Look for signs of overconfidence. Did you increase your size too quickly? Did you ignore your stop loss? Did you chase trades? These reflections build self-awareness, which is the key to controlling overconfidence. A story to illustrate this, I once saw a trader blow up a $50,000 account in less than a month because he was riding a hot streak. He increased leverage on every trade, believing he was invincible. When the market finally went against him, the losses compounded rapidly. He didn't have a plan for risk, and his ego cost him everything. In contrast, I had another friend who experienced the same streak of wins but stuck to strict risk limits. He took smaller positions, kept stops tight, and pulled back when conditions weren't favorable. Months later, his account had grown steadily without big drawdowns. He wasn't a hero every day, but he was a survivor, and that's what matters. Overconfidence can also lead to ignoring external factors such as economic data, earnings reports, geopolitical events, or even market sentiment. When you feel invincible, you start to believe.
Chapter 7. Fear of missing out, or FOMO as everyone calls it, is a sneaky, destructive force in trading that has ruined more accounts than you can imagine. It's a feeling you know well, that gnawing anxiety that everyone else is making money while you're sitting on the sidelines. That impulse to jump into a trade just because the price is moving fast and you don't want to miss the big move. It's a feeling that pushes you to throw caution to the wind and chase the market instead of waiting patiently for your setup. FOMO is one of the biggest killers of consistency, and consistency is the holy grail of trading success. No strategy works if you can't execute it with discipline day after day. When FOMO takes hold, it clouds your judgment, wrecks your emotional balance, and tempts you to make impulsive decisions that have little to do with your trading plan. The moment I first truly felt the power of FOMO was early in my career. I was watching a stock rally hard, and everyone on the trading floor was buzzing about it. The price had already run up 10% in a couple of hours, and my gut screamed, "Get in now!" I was scared I'd miss out on the profits. Against my own rules, I jumped in without a proper setup or plan. The stock soon reversed sharply, and I was forced to take a loss. That day, I learned a painful lesson. Chasing the market out of fear doesn't lead to profits, it leads to regret. FOMO often tricks you into entering trades late. Instead of entering at the start of a trend or at a well-defined support or resistance level, you buy after a big price move has already happened. At that point, the risk-to-reward ratio is usually poor, and the chance of a pullback or reversal is high. You're chasing the trade, hoping the momentum continues, but markets rarely move in a straight line. This kind of trading is gambling, not strategic investing. What makes FOMO so dangerous is that it's tied directly to one of the most primal human instincts, the fear of being left behind. Whether it's stocks, cryptocurrencies, or commodities, when traders see others making money, the natural reaction is to join the party. No one wants to feel like the last one to discover a winning trade. Social media and trading chat rooms amplify this feeling, showing endless screenshots of profits, enticing beginners and veterans alike to jump in impulsively. But here's the truth. There will always be another trade. Markets run in cycles, and opportunity is never ending. You don't need to jump on every move or trade every day. In fact, the best traders often spend more time waiting than trading. They understand that patience is a weapon, not a weakness. One of the worst effects of FOMO is that it leads to overtrading. You take too many trades because you're afraid to miss a winner. This increases transaction costs and spreads your attention too thin. When you're overtrading, you're more likely to make mistakes, ignore your rules, and burn out emotionally. Overtrading also amplifies risk. Many traders respond to FOMO by increasing position size, thinking that a big win will make up for missing earlier moves. But this is the exact opposite of risk management. Larger sizes combined with impulsive trades can quickly wipe out your gains or your entire account. How do you combat FOMO? The answer lies in discipline, planning, and mindset. First, you need a clear trading plan. Your plan should define exactly when you will enter a trade, how much you will risk, and when you will exit. When your rules are clear and detailed, it becomes easier to say no to impulsive trades. Your plan becomes your anchor when the emotions surge. Second, develop the habit of waiting for your setups. This is easier said than done, but it's essential. Instead of chasing the market, focus on quality over quantity. Be patient enough to wait for ideal conditions. It might feel like you're missing out, but in reality, you're avoiding traps that cost money. A helpful mindset shift is to see missed trades as a sign of discipline, not failure. Every trader misses a good setup now and then. That's part of the game. But those who succeed consistently are the ones who accept missed opportunities without anxiety. They know that trading is about probabilities, not guarantees. Missing a trade doesn't mean you lost money. It means you preserved your capital for better setups. Another technique I recommend is journaling your emotions and decisions. When you feel FOMO rising, pause and write down what you're feeling and why you want to enter a trade. This practice builds self-awareness and helps you catch emotional impulses before they lead to bad trades. Over time, you'll recognize your FOMO triggers and develop strategies to manage them. Technology can also help. Use alerts and watch lists to track setups without feeling the need to constantly stare at charts or jump into trades immediately. Automated tools can remind you when your rules are met, so you don't have to rely solely on your emotions to decide when to act. It's also crucial to manage your expectations. No trader catches every big move, and that's okay. The market will keep providing opportunities as long as you stay disciplined and ready. Chasing every move is a fast track to losses, while selective trading leads to growth. FOMO often masks itself as excitement or confidence. You might tell yourself, "This time is different," or "I'm just going to add a small position." But small impulsive trades add up, and before you know it, your account is full of risky, unplanned positions. This is how many traders get caught in a cycle of losses. To break free, practice mindful trading. Before entering a trade, ask yourself, am I entering because this trade fits my plan or because I'm afraid of missing out? Am I calm and clear-headed or am I reacting to hype? Developing this moment of pause is a game changer. Another subtle effect of FOMO is the confirmation bias it breeds. After entering a trade out of FOMO, traders often look for signs to justify their decision, ignoring warning signals. This selective thinking can keep you in losing trades longer and cause bigger losses. FOMO doesn't only affect entry points, it also influences your exits. You might hold on to a losing position longer, hoping the market will turn around and you won't miss the recovery. Or you might exit winners too early out of fear of losing profits, again driven by anxiety. One story that stuck with me was about a trader who chased a popular tech stock after a huge rally. He entered late and then refused to exit despite clear signs of reversal, hoping the stock would resume its uptrend. Instead, it crashed, wiping out months of gains. His FOMO at entry and emotional attachment at exit destroyed his consistency and confidence. Remember, consistency beats heroism in trading. The best traders are not the ones who catch every move or have the highest win rate. They are the ones who follow their plan calmly, manage risk, and stay emotionally balanced through wins and losses. A powerful way to reduce FOMO is to develop a strong sense of purpose in your trading. Define your goals beyond just making money. Maybe it's building a sustainable income, achieving financial independence, or simply mastering your craft. When your trading has meaning, it's easier to say no to distractions and impulsive trades. Finally, it helps to disconnect from the noise. Social media, trading forums, and chat groups can fuel FOMO with endless stories of big wins. But these are often selective snapshots, not the full picture. Real trading success involves patience, losses, and boring periods of waiting. Focus on your journey, not on the hype. In conclusion, FOMO is a natural human emotion, but in trading, it's your enemy. It clouds judgment, leads to impulsive entries and exits, causes overtrading, and kills consistency. The antidote is a strong trading plan, patience, emotional awareness, and the mindset focused on discipline rather than chasing every move. If you want to be a successful trader, learn to sit on your hands. Wait for your setups, trust your process, and remember that missing a trade is not losing money, it's preserving it. FOMO kills consistency, but discipline builds it. Choose wisely.
Chapter 8. Trading Without Journaling. Trading without keeping a journal is like trying to fly a plane blindfolded. Imagine a pilot navigating through turbulent skies without any instruments, no flight data, no past flight logs, just flying based on gut feeling and hope. Sounds reckless, right? Yet, shockingly, many traders operate exactly like this, trading blindly without tracking their actions, mistakes, or successes in any meaningful way. This chapter digs deep into why journaling isn't just a nice-to-have for traders, but an absolute necessity. It's the difference between repeated mistakes and steady improvement, between emotional chaos and disciplined clarity. I remember early on in my trading journey, I didn't keep any kind of record. I thought my brain was enough. I believed I could remember my trades, why I took them, and what went wrong if I lost money. But after a while, patterns started repeating. I'd make the same mistakes, sometimes multiple times. I'd lose money,
chalk it up to market conditions or bad luck, and move on without reflection. My progress was slow and frustrating. Then I started journaling, and everything changed. Trading journals come in many forms, from detailed handwritten notes to digital spreadsheets or even sophisticated trading software. What matters is the commitment to record your trades honestly and consistently. The journal becomes a mirror reflecting your strengths and weaknesses, a factual record free from the bias of memory or emotion. Without a journal, your trading decisions become guesses or emotional reactions. When you lose, you might blame external factors. When you win, you might think you're a genius. But without data, you don't know the truth. You don't see the patterns that define your behavior or your strategy's strengths and weaknesses. You fly blind. Keeping a journal forces you to slow down and be honest. When you document each trade, you answer questions like, why did I enter this trade? Did I follow my plan? How did I feel? What was my risk and reward? Did I stick to my stop loss? How did the market behave? What could I have done differently? This process of reflection builds self-awareness, the foundation of any improvement. I've talked to countless traders who said, I don't need a journal. I just trade with my gut. But trading isn't a gut game. It's a skill based on learning and adapting. Your gut can be clouded by fear, greed, and overconfidence. A journal keeps your decisions grounded in facts. One key benefit of journaling is it reveals hidden habits and emotional triggers. For example, you might notice a pattern of entering impulsive trades after a loss, or increasing size after a win, or holding losers too long. These patterns, once visible, can be addressed systematically. Without a journal, these destructive habits persist unnoticed, silently draining your account. Journaling also helps you measure the effectiveness of your strategy. Trading systems aren't perfect. They have strengths and weaknesses that vary by market conditions. By recording details such as entry points, exits, stop losses, and outcomes, you build a database to analyze what works and what doesn't. This is how you evolve from guesswork to a data-driven approach. Another powerful aspect is emotional regulation. The markets are emotionally charged. Even experienced traders face anxiety, fear, and doubt. Writing down your feelings during each trade can help you recognize how emotions affect decisions. Over time, you develop the ability to detach emotionally and trade with discipline. The process of journaling also enforces accountability. When you know you have to record your trade and explain your reasoning, you're more likely to stick to your rules. This reduces impulsive, undisciplined trades. Technology has made journaling easier than ever. There are apps and platforms designed specifically for traders, offering templates, automatic trade import, and analytics. But the tool you use is less important than the habit of consistent journaling. One common fear traders have is that journaling will be time-consuming or boring. It doesn't have to be elaborate. Even a few sentences about why you entered or exited a trade and how you felt can be incredibly valuable. The key is honesty and regularity. The process of reviewing your journal is as important as writing it. Set aside time weekly or monthly to analyze your trades. Look for recurring mistakes, emotional patterns, and strategy weaknesses. Ask yourself tough questions. Am I following my plan? Where do I lose the most money? What times or instruments are most profitable? These insights are gold. I recall a period when my journal revealed a disturbing trend. I was consistently losing money on afternoon trades. Digging deeper, I realized I was trading while tired and distracted. Once I identified this, I adjusted my schedule and cut out afternoon trades. My performance improved dramatically. Without journaling, I would have kept losing money blindly. Another trader I know used journaling to discover that he increased position size recklessly after a string of wins. This overconfidence was causing huge drawdowns. Recognizing this behavior helped him build strict rules on sizing and risk. Some traders also use journaling to track non-trade activities like studying, market research, or even their sleep and fitness. Trading is a full-body, full-mind endeavor. When your lifestyle supports your mental clarity, your trading improves.
Journaling also preserves your lessons. The market changes, strategies evolve, but your core lessons remain. Looking back on your journal months or years later can reinforce what you learned and remind you why discipline matters. The benefits don't stop there. Journaling creates a feedback loop where learning accelerates. Each trade becomes a lesson, and every lesson makes you better. This continuous improvement mindset is what separates consistent traders from gamblers. Without journaling, your trading becomes reactive, emotional, and inconsistent. With journaling, it becomes intentional, disciplined, and adaptive. If you want to be serious about trading, start journaling today. Write down your trades, your thoughts, your emotions, your plans, and your outcomes. Don't skip it. Don't ignore it. Your journal is your trading coach, your accountability partner, your record of progress. In the end, trading is a journey, not a sprint. Journaling is the map that guides you through the ups and downs. It's the difference between flying blind and flying with precision. Remember, the best traders aren't those who never lose. They're the ones who learn from every trade, get better every day, and never stop growing. Journaling is the key to that growth.
Chapter 9. Blindly Following Gurus. In today's digital age, trading has become more accessible than ever. Anyone with a smartphone can watch videos, read tweets, and join chat groups where gurus promise to reveal the secrets to quick and easy profits. It's tempting to follow these self-proclaimed experts, especially when they showcase flashy results, expensive lifestyles, or constant wins. But blindly following gurus without truly understanding their strategy is one of the most costly mistakes a trader can make. This chapter explores why relying on others' advice without critical thinking can derail your trading career and how you can protect yourself from falling into this trap. I remember the first time I got caught up in the guru hype. Early in my career, I stumbled across a YouTube trader who seemed to have it all figured out. His channel was full of shiny screenshots, promise-filled tutorials, and a community of loyal followers. I thought, if I just follow what he does, I'll be rich. So I started copying his trades, his entries, even his risk levels. But I didn't have the context, the mindset, or the risk tolerance he did. Within a few weeks, I'd lost a significant chunk of my account. The problem was simple. I was trading someone else's plan, not mine. Blindly copying gurus without understanding their strategy is like trying to run a marathon wearing someone else's shoes. The fit might be off, and the journey uncomfortable. Worse, you may end up injured or exhausted long before the finish line. Why do so many traders fall into this trap? First, the internet is filled with noise and hype. Social media platforms reward attention-grabbing content, not careful, nuanced advice. So the loudest voices often belong to traders who prioritize entertainment or sales over education. Their flashy results are real or staged, but what you don't see are the countless losing trades, the months of struggle, or the emotional toll behind the scenes. Second, many gurus sell courses, signals, or memberships. Their incentive is to grow their following and make money from it. While some do offer valuable content, many don't prioritize your education or success. They want customers, not students. Third, it's human nature to look for shortcuts. Trading is hard. It demands discipline, patience, and continuous learning. Following a guru's secret seems easier than grinding through years of trial and error. But shortcuts often lead to dead ends. When you blindly follow someone else, you hand over control of your trading to a stranger. You lose the opportunity to develop your own skills and understanding. Trading becomes reactive and dependent instead of proactive and empowered. Another danger is misalignment of goals and risk tolerance. A guru might be day trading with a large account and a high-risk appetite, while you might have less capital and a different lifestyle. Copying their trades means exposing yourself to risk levels you're not comfortable with. This mismatch can lead to panic, emotional trading, or blowing up your account. Also, many gurus don't disclose their full track records or the times they lose.
They might cherry-pick their best trades for public display, creating a skewed perception of success. If you only see their winners, you might assume their method is flawless. But no strategy wins all the time. Every trader faces drawdowns and losing streaks. Ignoring this reality sets you up for failure. Understanding why a trade is taken is critical. Blind copying removes this understanding. You don't learn how to analyze setups, manage risk, or adapt to changing markets. You become a passenger, not a pilot. So, how can you avoid this costly mistake and build your own path? The first step is skepticism. Question what you see and hear. Don't take anyone's word as gospel, no matter how convincing. Verify claims, ask for proof, and dig deeper. Look for transparency, long-term results, and educational value, not just hype. Next, educate yourself. Trading is a skill that requires learning and practice. Read books, take courses from reputable sources, study market mechanics, and develop your own strategy. Education builds confidence and independence. Also, practice critical thinking. When you watch a guru's trade or strategy, ask yourself, does this make sense? Can I explain why this trade is being taken? How does it fit with my goals, risk tolerance, and style? If you can't answer these questions, don't copy the trade. Develop your own trading plan based on your personality, capital, and objectives. Tailor your approach to your strengths and weaknesses. This takes time, but it builds resilience and control. A valuable habit is to paper trade or demo trade new strategies before risking real money. This allows you to test concepts in your own environment without risking capital. Beware of too good to be true promises. No strategy is perfect, and no one makes money 100% of the time. If a guru guarantees huge profits with little risk or effort, it's a red flag. Social proof can be misleading. Just because thousands follow someone doesn't mean they're trustworthy or effective. Popularity doesn't equal reliability. Another red flag is pressure tactics. If a guru urges you to buy courses or signals quickly or makes you feel you'll miss out, step back and evaluate. High-pressure sales often prioritize profit over your education. It's also important to recognize that even the best traders have different styles. One trader's method might be scalping, another might be swing trading. One might use technical analysis, another might rely on fundamentals. You need to find what fits you, not follow blindly what works for someone else. Building your own experience is the ultimate guru. The market is the best teacher, but also the toughest. It will test your discipline, patience, and resolve. The only way to succeed is to learn from your own successes and failures. Don't be discouraged by early losses or setbacks. They are part of the journey, but learn from them, record them, adjust your approach. Another challenge of following gurus blindly is the risk of copying outdated or unsuitable strategies. Markets evolve. What worked last year may not work today. Gurus often share holy grail setups that lose effectiveness as more people adopt them. Relying on someone else's method without adapting to current conditions puts you at a disadvantage. To really succeed, you must develop adaptive thinking. This means analyzing the market environment and adjusting your approach accordingly. It requires understanding the why behind your trades, not just the what. In my own journey, I've seen traders waste months or years chasing the latest guru system only to end up frustrated and broke. They switch from one method to another, never sticking long enough to learn or adapt. This cycle of chasing shiny objects is exhausting and costly. The antidote is patience and perseverance. Commit to learning, testing, and refining your own strategy. Use gurus as a source of inspiration or ideas, not as a blueprint. Some traders find value in mentorship or coaching, but the key is finding someone who guides you to develop your own thinking rather than handing you a ready-made system. The best mentors help you understand principles, risk management, psychology, and market dynamics. They don't just give you trade alerts. It's also helpful to cultivate a community of thoughtful traders, people who share ideas, challenge assumptions, and support learning.
Avoid echo chambers where hype replaces critical analysis. Remember, trading is a skill that blends art and science. It requires developing your own intuition based on experience, study, and self-reflection. In conclusion, blindly following gurus is a trap that leads to loss of control, misunderstanding, and often financial loss. The allure of quick riches is strong, but sustainable success comes from developing your own knowledge, discipline, and strategy. Question what you hear. Educate yourself. Build your own path. Trust yourself more than you trust anyone else's promises. Only then can you trade with confidence, clarity, and consistency.
Chapter 10. Ignoring the market context. One of the most fundamental mistakes traders make, especially when they're just starting out, is focusing too much on isolated chart setups and ignoring the broader market context. It's like trying to read a single word without understanding the sentence it belongs to. The market is a living, breathing ecosystem, influenced by countless factors: economic news, volume, time of day, sentiment, and more. When you ignore these contextual clues, even the best-looking setups can fail miserably. This chapter dives deep into why understanding market context is crucial for trading success, and how overlooking it can cost you both money and confidence. Early in my trading career, I used to obsess over specific patterns. A breakout here, a moving average crossover there, or a candlestick formation that looked promising. I thought that if I could just master these setups, profits would follow naturally. But I soon learned that even the most textbook perfect trade can fail if taken without considering what's happening around it. The context provides the backdrop that gives those setups meaning. Let's break down what market context really means. First, it includes news and economic events. Every trader has felt the sting of a sudden news release that sends prices wildly off course. Interest rate announcements, employment reports, geopolitical tensions, corporate earnings, and even unexpected headlines can dramatically change market behavior in seconds. Ignoring these events is like walking into a storm without an umbrella. For example, you might spot a bullish breakout pattern on a stock chart. It looks perfect. You enter a long position, expecting momentum to continue. But what you didn't know is that a disappointing earnings report just came out minutes before, sending the stock plummeting. Your setup failed, not because the pattern was flawed, but because you ignored the news context. Second, volume is a powerful contextual tool. Volume tells you how much interest and participation there is in a trade. A breakout on low volume often lacks conviction and is prone to failure or false signals. On the other hand, a breakout supported by high volume suggests strong buying or selling pressure and a higher likelihood of follow-through. Many traders focus only on price but forget to check volume. Without volume confirmation, you're flying blind. A candle that looks bullish on a daily chart might just be a thinly traded move with no real backing. This can lead you to take positions that get quickly reversed by more dominant market forces. Next, consider the time of day and session dynamics. The markets have natural rhythms, influenced by when major exchanges open and close, when institutional traders are most active, and when liquidity peaks or dries up. For example, the first hour after the U.S. stock market opens is often volatile and fast-moving, sometimes creating opportunities but also risks of whipsaws and false breakouts. Many setups that work well during high-volume periods may fail during low liquidity times, such as the last hour before the market closes or during lunch hours in some markets. Ignoring the time context can result in getting caught in moves that reverse when the volume disappears. Another important factor is overall market sentiment and trend. Are the markets generally bullish, bearish, or sideways? Even the best setups often fail when they go against the larger trend. Trading against the tide is difficult and requires additional skills like precise timing and strong risk management. For example, a reversal pattern that looks perfect in isolation might just be a small pullback in a powerful downtrend. Entering a long trade on such a pattern without recognizing the prevailing bearish market context can lead to a painful loss.
Furthermore, sector and intermarket relationships matter. Stocks within a sector often move together. If the sector is weak, even fundamentally strong companies can struggle. Similarly, movements in commodities, currencies, or bonds can influence equities. Ignoring these relationships is like ignoring weather forecasts when planning a trip. You miss vital information that affects the environment. I once traded a promising breakout in an energy stock, only to realize later that the entire energy sector was under pressure due to falling oil prices. The stock quickly reversed and my trade failed. Had I looked at the sector's health and commodity prices beforehand, I might have reconsidered. Beyond price and volume, technical indicators need context too. For example, an RSI reading of oversold might suggest a reversal. But if the market is in a strong downtrend fueled by negative news, the RSI can stay oversold for extended periods. Blindly buying on oversold signals without context is dangerous. Understanding support and resistance levels also requires context. Are you trading near major long-term support or just a minor intraday level? Major levels tend to be more reliable. Context gives weight to these levels, helping you decide how much risk to take. Ignoring context often leads to false breakouts, one of the most frustrating and common reasons trades fail. False breakouts happen when price briefly moves beyond a support, resistance, or trend line, but then quickly reverses. They suck traders in and shake out stops. Contextual clues, such as low volume, adverse news, or lack of trend confirmation, can warn you to be cautious. Let me share a story. I once traded a breakout of a key resistance level. The price popped above, and my technical setup was perfect, but the volume was unusually low, and there had been no major positive news. Within hours, the price reversed sharply, triggering my stop loss. I realized I had ignored volume and news context, jumping in solely on price action. That lesson stuck with me. So, how do you incorporate market context into your trading? Start by staying informed about economic calendars and scheduled events. Know when major reports or announcements happen. Avoid entering new trades right before highly volatile events unless you have a strategy designed for news trading. Second, always check volume alongside price. Look for volume spikes confirming breakouts or reversals. Be skeptical of moves on thin volume. Third, observe the market trend and sentiment. Identify if the market is bullish, bearish, or range-bound. Trade in alignment with the trend or use special strategies for counter-trend trades. Fourth, consider the time of day and your trading style. Some traders specialize in high volatility periods, others prefer calmer times. Understand when your setups perform best. Fifth, analyze sector and intermarket factors. If you trade stocks, watch sector ETFs and commodities that affect your picks. If you trade Forex, watch related currencies and global economic trends. Sixth, use technical indicators as tools, but never blindly. Understand how they behave in different market conditions. Contextual awareness also helps you size your positions. If market conditions are uncertain or volatile due to news, you might reduce size to manage risk. Another overlooked factor is market liquidity. Thin liquidity can cause erratic price moves and slippage. Trading during low liquidity periods without understanding the context can lead to unexpected losses. It's also valuable to keep a journal of how your trades behave in different contexts. Over time, you'll notice patterns. Which news events affect your instruments most, which times of day your strategy performs best, and which volume patterns signal strong moves. Ignoring market context often reflects impatience or a narrow focus on technical setups. The market is complex and dynamic. Embracing context means acknowledging that no trade happens in isolation. In my experience coaching traders, those who master contextual analysis consistently outperform those who rely only on isolated signals. It's like playing chess without seeing the whole board and playing with full awareness of all the pieces. Market context isn't about complicating your trading, it's about enriching your understanding to make smarter decisions. When you combine good setups with the right context, your win rate and confidence improve dramatically. On the flip side, Ignoring context leads to frustration, bigger losses, and the feeling that the market is against me. But the market isn't out to get you, it's just telling a bigger story. Learn to read it.